Hello and welcome to FidelityConnects. I'm Marilyn Bardaji, District Vice President of Sales. The Federal Reserve has slashed their benchmark interest rate by 25 basis points. Citing labor market weakness and continued margin pressure, this is the third and final rate cut of 2025. With the yield curve beginning to re-steepen and economic activity softening, the shift sets the tone for how investors should think about positioning into 2026 and beyond. Our next guest says this environment only reinforces the stretch for quality and momentum, two factors he believes are best suited for the K-shaped economy. Joining me now to unpack what this may mean for factory leadership, including how AI and tariffs may shape the path ahead, is Fidelity Head of Quantitative Index Solutions, Bobby Barnes. Welcome, Bobby.
Thank you.
Thank you for joining us all the way from Boston.
It's indeed. It's good to be here.
Thank you for having us. Bobby, it's quite an eventful day today. Both the Bank of Canada and the Fed met for the last time this year to decide how they go about interest rates, and we'll get to it. But before we do, I'd like you to talk to us about the quantitative research team. So how did the team come about? What is it exactly that you do? And that data, is it only used for our quant products, or is it also used by some of our fundamental portfolio managers here at Fidelity?
Sure, yeah, there's a lot to unpack there. So I'll start with my favorite story, which is that unbeknownst to a lot of people, Fidelity's been doing quant for a very long time. So we hired our first one back in 1965, and his job was to help the firm understand how to use the computer, because there was only one back in those days. But if we fast forward, in particular, I would talk about how the quant took shape around the mid-2000s, because that's more similar to what it is today. And so historically, quant had been an independent silo separate from our fundamental department. And then in the mid-2000s is when they integrated the two together to identify stocks that are attractive both fundamentally and quantitatively. And so that's how I spent most of my career. I started full-time in 2009, working alongside with many of the portfolio managers that Fidelity Canada knows and has money invested with. And I created the models, the quant models, using the best ideas and approaches, both quantitatively and fundamentally. And it's those insights that led to the factor ETFs that we ended up launching, both here in Canada and in the US. Having said that, where we are now is even more integrated. And so, depending on which specific quant team you're talking about, we've got teams that are like the ones that I started on. We call them the embedded equity team, where you're working one-on-one with quant portfolio managers. We also have, because quant naturally is very, technically inclined, we used our quant expertise to build technologies to help augment the fundamental job. And so what that might look like would be, as you can imagine, our fundamental analysts who are experts in every area or industry across the globe, they publish tremendous amounts of research daily. And one of the technologies we've built is an AI engine that will help portfolio managers summarize all the research that's published internally and elevate the most attractive ideas that they should add to their portfolio. And so that's one way of enhancing the portfolio management job. We do the same thing with analysts, where if you think about the day-to-day job of an analyst, you're on earnings calls and you're summarizing the information that is presented by management on those calls. There are only so many hours in a day, so you can't sit in on all the calls. And so we've built systems that will do that for the analyst, and again, summarize all the relevant information to help speed up the number of rocks that they can uncover, so, as we like to call it.
Right. You've also said when we spoke to prep this call that you do work alongside, portfolio managers like Will Danov, Joel Tillinghast.
Yep.
So how do they use that research? You mentioned, the making it easier to read some of the, Atlas reports and whatnot, but how do they look at the data that you provide for them? How do they use it?
So the job of a quantitative analyst is that are partnered with our portfolio managers, like a Will and a Joel, is twofold. One is to provide stock selection ideas, and then the other is to help them with portfolio construction. The former, however, usually what happens, like if I'm working with any portfolio manager in my prior role, because now I'm managing the ETF business, but we still have other quantitative analysts who are working directly with those portfolio managers on a day-to-day, they will, sit with a Will and say, okay, Will, talk to me about your investment philosophy. How would you articulate that? And then the job of the quant is to take, what's said and translate that to, okay, if Will just said, I like, companies that have, durable moats and are compounders over time. What does that mean quantitatively? And then develop a model that's really custom tailored to Will and his process. And so that's what I did over the course of many years, and many of our quantitative analysts are still doing that today. And that's what that will look like, is they'll surface those ideas that are custom tailored to the portfolio manager based off of their investment philosophy, but then also help them create a portfolio based off of those ideas, with the idea of maximizing exposure to the most attractive stocks while minimizing any unintended risks.
So how advisors here in Canada know you is through the all-in-one ETFs, or the factor, as we call them, the factor ETFs. Can you talk a bit about how those factors went for this year? What do you see working well for 2026? So what are your perspectives?
Yeah. So it's been a very interesting year, and especially when I look at, we've got a global offering here in Canada. And so what's worked has somewhat rhymed depending on the region, but there are subtle nuances, across regions. And so the way to think about that is to first orient around the economic cycle and where each region is within the business cycle. The U.S. is currently in late cycle. It's kind of where we've been since, call it 2022 and 2023. Canada and Europe are actually closer to being early cycle. And so what that has meant from a factor perspective is that the best performing factors in both Canada and in Europe have actually been value. And momentum has done very well as well in both of those regions. Whereas the US market, because it's late, value typically doesn't do as well in the US market. And so the best performing factor year to date has been momentum and quality, which is usually what also does quite well during late cycle. It did well at the start of the year, but because of some of the tariff tantrum, and particularly the recovery after the tariff tantrum, it has not done as well, because that's been more characterized as by a junk rally, if you will, in the US market specifically.
Right. So do you think that for the US for 2026, I think I mentioned it's also the same two factors, right? Momentum and quality that you see working well?
Yes. So my forward forecast would be an overweight to momentum and quality for the reasons that I mentioned, kind of anchoring in on the cycle, not only where we are in the cycle, but what I think will likely be the cycle that we will be in 2026. And so, I think we're going to be in an elongated late cycle, which means there's positive growth, but growing at a slower rate. And so high quality companies with high profit margins, they tend to do the best in that environment. And the thing is, there's still risk to margin. So, you kind of said it at the open, where there are risk to margin compression for some companies. Mm-hmm. And so in that environment, you typically want to shade higher quality, because they have higher margins and have more room to flex if they need to. Similarly, momentum is a slightly different narrative. That typically, the trend is your friend is the axiom that usually goes along with that. And unless we have a big change in the trend that we've been in 2025, then I would extrapolate that out to 2026 as well. And the last point I would make there is that you've with the momentum portfolio in particular, it has a lot of exposure to AI. Right. And that's been, I think, top of mind to a lot of people. So there's no surprise there. I also think it still has legs. I think it still has runway to continue into 2026, because these are very long projects that people are embarking on in doing the AI build out.
We can talk about let's talk about the AI trend now and go back to the factor later. So obviously, somebody who wants exposure to AI, you said momentum. What Yes. can they expect to get? And what's your thought? Are we in a bubble? Do you have any thoughts on that?
Yes, I have many thoughts. So the first thing that you have to understand about AI is, a lot of people, when they talk AI, they just associate that with Mag 7. But there are very different parts of AI. And so let me break it down. Most of the Mag 7, they're doing the spending to build out AI, and I call it AI as a service. And so, if you go on Google right now, you can get and ask a question, you can get an answer from AI, the Google AI. But no one, for the most part, is making any money off of that. That's much farther in the future, and so to the extent that people are worried about, well, when are these companies start making money? I actually would submit, okay, or ignore that for now, because the most of them that are spending the money to build it out, they're actually highly profitable already. So I don't worry about whether or not they're going to make money eventually. It's neither here or there, in my opinion. What's more important about AI is where it's what I call the enablers. And so what's happening is to do the build out, that's happening at the Max 7 level, they're spending a lot of money, and that money they're spending ends up being revenue for somebody else. And that's where, if you look year to date, for example, those enablers who are, doing the picks and shovels of building for the service providers, their earnings are inflecting tremendously. And along with that, because we always say that stocks follow earnings, their stock prices have done tremendously well in 2025. And so these build outs, there was a number I saw where I think globally there are, and don't hold me exactly to these numbers, but globally I think there are about anywhere between 2,000 and 3,000 data centers. That number needs to double over the next 2 to 3 years. And so that's going to create a lot of business opportunity for those enablers.
So you're saying that those Max 7, those big companies are feeding the smaller ones, right?
Yes.
So what does that mean? Does that mean you have, because I heard you say you don't necessarily like small caps. What does that mean in terms of perspective for those smaller companies?
So there's a subtle nuance there that I should clarify, because they are smaller than the Max 7, but for their individual industries, they're actually the biggest ones. And so the way to think about that is, Max 7 is mostly tech, those names. But when they buy a microchip for AI, you need a world-class microchip. And so the best microchip provider is basically the bigger one, the bigger company. Right. So you're not buying the smaller microchip provider. So then after you've bought your microchips, where are you going to put them? I'm going to put them in a data center, which is basically a warehouse. And the warehouse gets hot because there are a whole lot of microchips in there. I need to cool it. Similar thing. Okay, so when I spend money on the HVAC company to do the cooling, it's the biggest and the best HVAC company. And so all HVAC companies are smaller than the Max 7, but you're still not, it's not the case that I'm choosing the small HVAC company. And so for that reason, if you segment the market by market cap, you say, okay, give me the biggest companies within each industry. It's the bigger ones within each industry that are doing well year to date. And I think because of the reasons we're talking about, and will likely continue to be the beneficiaries and the outperformers in 2026. And so you don't want to, controlling for industry, you don't want to shade down in size.
Right.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
You look at data, ratios, numbers. Do you see a lot of similarities or differences with 2000 for people wondering, if we are in a bubble, what are your thoughts on today versus 2000?
So your question is dead on where I'm spending most of my mental calories.
Right.
I do see a lot of similarities between now and 2000. I guess if I take a quick step back, because I just realized I didn't answer one of your questions about a bubble. I think we are going to be in one or have one, but I think we're in the earlier innings of it right now. Right. And if you just listen to what the Max 7 or the AI spenders, the ones who spending to do the build out, listen to what they say to you. They've basically said to you they're going to overspend because they view the risk of coming in second as being bigger than the risk of overspending on the build out. Right. So by definition, we're going to overspend. By overspend is going to be too much spending, and thereby a bubble. But
And they're leveraging right now, right? With the bond issues and
they are, and that worries me some. Most of the Mag 7, however, they're very profitable. They have super large cash flow. So while they're leveraging to finance some of this build out, I think they're going to be okay. There is a subset of private companies, however, that you have to consider beside the Mag 7. So OpenAI, Anthropic, XAI, they're also doing the same spending. But the difference between them and the Mag 7 is they don't have any profits and they're raising the same amount of debt. So that's the part that concerns me about the debt that's being raised. But we'll see how that ends for them. But if you look downstream, to the companies, the enablers that I talked about, when I think about what's the runway for their profitability and their revenues, the risk, I think, is any business they're getting from the private AI companies, in the event that those companies aren't able to access financing in the way that they have before, that's going to cause trouble downstream to the HVAC company and the data center build out company. And so that's the risk for them. And then the other similarity to the .com, the 2000. The thing about the .com is first of all, valuations got crazy. Like we were valuing companies based off of eyeballs. Like that part was crazy. But there was an element of fundamentals. There were companies that were making money. So back then we were laying a bunch of fiber in the ground, right, for the internet. And so it was a similar thing. It's not the case that the company that was digging the holes to lay the fiber, they were making a lot of money. But what happened was you had, the parallel, the overbuild out. And so, once, too much fiber had been laid, the company that had earned a lot of profits from that, their revenues dissipated or evaporated because they didn't need to lay net new fiber. We weren't using the fiber we already laid. So that's my concern in this environment. Like, okay, if I'm investing in the company that's, laying the connections between data centers, which is actually, obviously a thing, if we get to the place where we have too many data centers, you no longer, that particular company, their economic prospects might diminish. And so that's the risk.
Right.
But having said all of that, I do think we're in the earlier innings versus later.
Right.
But it's something that I'm keeping a watchful eye on.
Yeah, so the market could go up for a while. That momentum could continue for a while. You've talked about areas of concern or where we're trying to be more careful. Let's talk about areas of opportunities. You had a thought on tariffs, right? And the potential for them not to be implemented or approved, right, by the Supreme Court. So what are your thoughts on tariffs?
Yes, so the tariffs is a very interesting discussion. And let me just first frame what's transpired over 25. Because it's, my entire process is anchored on earnings revisions. I always want to be invested in the companies where revisions are going higher, which means things are getting better. Fundamentally, things are getting better. As we traverse through 25, at the start of the year was kind of the extension of the AI trade from 2024. Things were hunky-dory. When we had the tariff announcements, across the board, earnings revisions for most stocks went down, right? And that's why the market went down. But then when we had the tariff pause, what happened was, and rightfully so, analysts said, okay, there's not going to be as much margin compression. So let me take estimates back up again. And so that's why you had the recovery that we experienced from, let's call it April 8th to present. And so sitting where we are right now, tariffs for me it's kind of my wild card. And so I just shared with you what my outlook is for 2026. And I would say that that outlook assumes the status quo, which is that you keep the tariffs that you have right now. Ironically, it's just I'm not a legal person, but so in my humble layperson's view, I think that the tariffs that are being reviewed by the Supreme Court right now are going to be shot down. It's because they were put in place under the premise that we had a global emergency. which is a kind of that's a high bar to prove that globally we were in an economic emergency.
Tell me if you've heard this, but I heard that there's a way for them to, if that doesn't work out, to find a different way for them to be implemented would be 150 days and maximum 15%.
Yes. So they have a variety of different ways to put some of them back on. And it's going to take a while because there's a lot of red tape and procedures to get there. And to your point, some of them have caps.
Right.
And so in my mind, if it gets struck down, two things are going to happen. The first is that it's going to be, especially if they get struck down and it's being deemed that they need to be paid back, right, that's going to be tremendous economic stimulus to these companies that are getting these dollars back. And that kind of negates my outlook partially, and from a factor perspective for 2026, because when the money comes back, it's the weakest companies that money is going to be most helpful for. And so now you don't want the high quality company. You actually want the smaller cap, which right, I said I otherwise don't like. You want to be in the smaller cap, riskier companies, because that stimulus is going to be a huge helpful tailwind for them. But to your point about, okay, well, what if they come back on again? What if they just find another way to put the same tariff back on? For that reason, it's going to take time, but they're actually, I think they're absolutely going to do that. And so I think that it reduces the amount of time that trade can persist. That you have the risk rally for 150 days, right, exactly the amount of time it takes them to put it back on, and then you kind of get back to the status quo where we are now. And so I could see a scenario where in 2026 you could have two different paradigms. It's like, okay, it got struck down, risk on, markets inflate, party. And then when they eventually get put back on again, it's like, okay, now we're back to the status quo that we're essentially at today. And the prescription would be for momentum and quality to be the key factors for outperformance.
Still, momentum and quality.
Yeah, on the back end of this stimulus from getting your tariff money back.
Right.
Yep.
You did say something also about a déjà vu model that you use.
Yes.
So I think people like to know, that we can try to predict, obviously, or no one has a crystal ball.
Yeah.
But there's something that you use just based on ratios called the déjà vu model.
Yes.
Can you explain what that is?
Yeah. So, I always like to, keep things simple. So the déjà vu model looks at 15 different macroeconomic variables. And let me just pick one for illustrative purposes. If you take unemployment and just plot it through time, it has a pattern. It kind of goes up in recessions and then goes down for, most of the rest of the cycle. And then it kind of goes up in the next recession again. And so that wave pattern of the chart, if you think about it, I can look at unemployment today, just the level, and look back at points in time and say, what are the points where we at this level? To keep it very simple. And so if I do that for all 15 variables, and so we look at, I mentioned unemployment, but you can think about the ISM, which is an expression of economic activity. It also kind of has a wave pattern to it. And so if I take all 15 of them and the levels that they are today and say, okay, that kind of creates a fingerprint, 15 different levels. And so I look at historically, where are the points historically where those 15 different levels were at similar points as they are today. And it's really cool because then I can extract out, okay, these are the 10 most similar points to today. And it does a fairly good job of identifying where you are in the economic cycle today, based off of those historical similar periods. And the reason that's important is, macro timing is hard, but and people don't like to do it because it is hard. But the thing is, after the fact, whatever macro environment you were in, it's going to affect your portfolio. So even though it's hard to do, you still should do it to have some forecast. You can't get by with no forecast.
Right.
Is the punchline. And so that's the model and how we use it. And it does say that where we are today, and this has been so for a while. It says that the U.S. economy is in where we are from these macro variables. It looks most like the late cycles of prior years.
Right. My question to you was about those indicators that you use, right?
Yeah.
So they're leading indicators probably. How does it change over time? Do some leading indicators, as the cycle changes, do some relationships go, changed and make a leading indicator not as useful, that you change that model, essentially, is what I'm trying to ask, based on the fact that relationships over certain indicators will change or not be as important to lead or predict going forward?
So that's an interesting nuance. They aren't leading indicators per se. And so the way to think about it more so is the term that gets used is nowcasting. So, if I go back to my example of unemployment, in the US right now, unemployment is at 4.3%. And so I'm just looking at the prior points historically that the unemployment was at 4.3. That's all you're doing. And there's no prediction per se in and of itself, but the way that we use it to make a prediction is I find all those periods historically where the unemployment was at 4.3, right, and then ask the following question, or the follow-up question: what did the market do 1 year forward from all those points in time? Right. And so that becomes the prediction, if at all. But the macro variables themselves, though, aren't leading indicators that are predicting the economic cycle in any kind of way, if that makes sense.
Absolutely. Bobby, we have only a few minutes left, and you're the brains behind those factors, right? So let me spend the last few minutes that we have talking about those factors. Can you talk a bit how they differ, versus other indicators or other factors that other companies might have? What makes us a bit different?
Yeah, so it gets down to the DNA, Fidelity's DNA. Number one, we're an active manager. We think about the world actively, and for any portfolio that gets created, we're very intentional about what active bet versus the benchmark are we making, with the idea of identifying the stocks that are going to outperform the benchmark. We do that quantitatively, and we do that fundamentally. So that's the first way that we're different, and that really informs our portfolio construction. But if I go a layer deeper, okay, Bobby, that's how you create the portfolio, but how do you choose the stocks within the portfolio? Mm-hmm. Same thing. We are taking our insights. We've got all these industry experts on the fundamental side. We've got all these talented quants on the quantitative side, and we take the best approaches from each side, and that's what informs how we go about selecting stocks. And so just kind of make that concrete with a different example. With value, we are very thoughtful on how we identify a value stock that we think is going to outperform over time. We don't take the traditional passive approach, whereas we just value a company based off of price to book. I can tell you from my days of working alongside various fundamental portfolio managers, there are many industries where price to book is literally the worst way to value a company. And so we don't do that. And so the approach that we use here in Canada and the US, we look at price to tangible book because it's a more conservative view of valuation, and does a better job of assessing a margin of safety based off of valuation. Next, we look at price to free cash flow. And so what I'll tell you about that is that if you could only do one thing, that's the one to do, because cash is king. And so if a company is cheap versus the cash flows it's bringing in, that's the best expression of valuation. And then the next two will be priced to next 12-month earnings, with the idea is that you want to have some valuation that incorporates the future fundamentals of a company. And then I'm going to blank on the fourth one. It's is that it price to free cash flow, price to tangible book, EV to EBITDA, which is another expression of valuation, but it's expressed from the statement, from the income statement versus the other variables that I mentioned that are expressions of valuation, but from other financial statements.
That's interesting. There's so much detail that go into, making those factors. So congratulations for you and your team. I mean, those products are very successful, and I believe that we are at time. So thank you, Bobby, for your time, and to advisors who tuned in, thank you for joining us this week on FidelityConnects.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.